You can't come into those markets as a late entrant without early mover advantage, offering generic proposition and expect to scale.
Today, I'm joined by a true titan of the African digital financial services landscape, Olu Akanmu. His resume reads like a masterclass in scale. From his years building massive retail distribution systems in the pharmaceutical sector to doing the same for giants like MTN and FCMB. Most recently, he served as the president of OPE. He understands the street, the boardroom, and the classroom. As usual, his insights are spot on, and I can't wait to share them with you. Let's dive in.
We have to be honest and forthright. The banking lobby deliberately slowed the entry of the telcos into the financial space.
Listen, across the continent, mobile money has been a huge driver of financial inclusion. I want to understand Nigeria's curious relationship with mobile money and why we haven't seen it really take off in that market.
We have seen financial inclusion largely correlates to prosperity, but it's a chicken and egg situation. Was it a prosperity that made people to be financially included, or the financial inclusion enabled people to be more prosperous?
Welcome to the F Squared podcast. First, you'll notice that I changed my wardrobe mid-session. We had an issue with power, it just went off, and so we had to take 2 takes for this recording. So let's get started, Olu. Thank you so much for joining this. I really appreciate you having you on the show. I think, from the outside in, I don't know you personally. I've just been following your profile and your work on LinkedIn and everything. And I think one of the things that really strikes me is just, you've got a very well-rounded career and perspective on financial services, right? In the sense that you have started off in, you've done work in the telco space, you've done work in banking at a very serious senior level, and you've also done work at a large-scale fintech at also a very senior level. You have been involved in policy through the, FINA, and now you're in academia through the Lagos Business School. So you're one of the rare people who has the scars of the battlefield, the commercial battlefield, with the finesse of academia. And I thought it was really good to have you on the show.
Thank you, Samora. Thank you for the invitation.
Yeah.
Once again, let me thank you for all that you do on behalf of so many people that you don't know, who benefit from your thought leadership across the continent and across the world. Thank you, and very well done. Thanks for the invitation.
Thank you so much. So we'll start with an area that I think you have a lot of experience. I think you shared a report on LinkedIn last year around FINA's work on financial inclusion, and this is the organization that is in charge of financial innovation and access in Nigeria. It was very interesting. Like the green areas were the areas where there's good financial inclusion, and I think the red areas were the areas where they're still lagging. And you had, a lot of green in the south and southwest, and a lot of red in the middle and northern parts of the country. Nigeria has done a lot of work over the last, actually 14 years in, improving financial inclusion, but clearly there's still some work to go. And I think the thing for me is that there are almost 2 angles to discuss, right? The first angle is that, the world seems to be moving away from financial inclusion more into things like financial empowerment, but you've still been very vocal about the need to increase financial inclusion in Nigeria specifically. So that's the first angle. And the second angle is that in the northern parts of the country, there are deeper problems around infrastructure, security, and all that kind of stuff. And is it even feasible to now have financial inclusion at a good level in those areas? I think it'll be good to just start from there.
Yeah, thank you. Very good question to start. Nigeria is a very interesting test case or model case for Africa, and there are a lot of very important learnings. Yes, we have seen financial inclusion largely correlates to prosperity, but it's a chicken and egg situation.
Yeah.
Was it a prosperity that made people to be financially included, or the financial inclusion enabled people to be more prosperous? I think it's a largely academic debate.
Yeah.
Fact is that we need to solve the two problems together. Economic inclusion programs do not succeed and scale unless people are digitally included. Yet, one of the biggest lessons we are seeing in Nigeria with the hard lifting we are witnessing in northern Nigeria, where poverty is very endemic, is that unless we also tackle economic exclusion issues, we will not make strong progress in financial inclusion. So we do, and one of the big lessons from Nigeria, from the FINA studies, is that 60% of the reasons why people do not have financial accounts, when they say, why don't you have a financial account? 60% of the reasons are economic. I don't have money, I don't have a job, or I don't have money to put in my account.
Yeah.
So that's one of the lessons. But it is not an either or. It's something we have to solve together, especially in northern Nigeria, where poverty is endemic.
Yeah.
And economic exclusion is endemic, and we're also seeing the highest rate of exclusion, as high as 60% in many of the northern states of Nigeria.
And it's it's a major problem that needs solving. And you're right, like you have to have both economic inclusion so that you can get financial inclusion. But I think also, if I look at Nigeria as an outsider's perspective, I think the digital inclusion has largely been driven by both banks and fintechs, right? It's one of the only countries where you don't have like massive mobile money at scale, right? Like really large scale mobile money. And for me, I've always argued that, if you look at cost to serve, I think mobile money is a very strong proposition because given the infrastructure already exists, people already sending messages to each other, like the cost to serve that specific client or the cost to acquire that specific client is almost zero, like it's very low. And so across the continent, mobile money has been a huge driver of financial inclusion. I want to understand Nigeria's curious relationship with mobile money and why we haven't seen it really take off in that market.
Again, a very interesting question. Let me add to the first discussion.
Yeah.
That one of the big things before I go to the mobile money issue is that we have to be far more deliberate to integrate financial inclusion programs into economic activities like agriculture and informal trade. For so long, these programs are run in isolation, and we have not been as intentional. And this is one of the key things in terms of the next phase of hard lifting that we have to tackle, along with using things like cash transfer, for example, to jumpstart inclusion among the extremely poor, as we have seen in markets like India. Now, the issue of mobile money and mobile money play in Nigeria is a very interesting one, because I think what has happened is that the telcos have largely come into Nigeria with a mindset of a virgin market where mobile money started, and without recognizing a more extensive and sophisticated context of the markets in Nigeria. You have 70 million people already with financial accounts, even though there's still a loss. It's 4% formally financially included, even though there's still a lot covered. You also have a very large fintech, sophisticated fintech participation. The fintechs have competed with the banks. One of them, for example, has 35 million wallets on this platform. When you have those kind of contexts, the model of entry has to recognize that competitive context. Where are the uncontested spaces, or how do we have a differentiated play in markets like Nigeria? You also have something interesting. Unlike many of the African markets where mobile money started, you already have 3 layers of payments working and competing. Cards are very extensive, very, very extensive all over the place. You also have, of course, the traditional USSD. Even before the telcos came, then you also have, now growing largely with what the fintechs have done, account-to-account payments. So the issue really is for the telcos to determine where are those uncontested spaces. Now, the uncontested spaces represents where they are the hardest economic inclusion issues. What you see is that the telcos don't want to go there. They seem to be looking for the fast pace of growth which they experience in Ghana, in Uganda, and in Kenya. And they also want to go to the markets that were already contested. And unfortunately, they have also not launched a differentiated play in those markets. You can't come into those markets as a late entrant without early mover advantage, offering generic proposition and expect to scale. I think that's the biggest lessons of the telcos. With the PSB license, they should be able to do more, but they don't want to go to those markets. They are not being as deliberate as intentional. And I think, like everybody, those markets are hard. You go to a lot of investment, and returns are going to be very small and very slow in short term.
And so, the point there is that from a very long time, actually, this agent model was, pioneered by the likes of Baga and others, more than 10 years ago. And therefore, they got going in the market. And of course, you've had now entrants such as OPay and MoneyPoint that have really scaled. And, the argument there is that why weren't you more aggressive in building this out and getting into the market, right? And even now, now that the market's already taken, you can't cherry pick. You have to actually do the hard, heavy lifting. But one would argue that maybe the playing field was never even from the start. It could be argued that, listen, there's a PSP license which has been issued to support the telcos, but across the other markets, there's nothing such as a PSB license. There's very standard regulations around mobile money. So why can't you just adopt the same regulations and then see if they have a more competitive position in the market?
Interesting. Maybe you say that the banking lobby in Nigeria is very strong.
Potentially.
It's more stronger than most African markets. We have to be honest and forthright. The banking lobby deliberately slowed the entry of the telcos into the financial space with the commitment that they were going to invest in what the telcos were expected to do. But it was actually the fintechs that actually solved the problem. It was the progressive regulation in the licensing paytechs much earlier than the telcos came in, competing with the banks, that extended the financial rails significantly. A lot of the growth that we have seen in the extension of financial rail had come from fintech impact. For example, total merchant agent population in Nigeria, maybe if we assume duplication, more than it will be about at least 1 million agents are out there, and about 1.5 million POSs have been deployed. These are so if the telcos and with the payments PSB license wants to come in, it is to us to understand the new context of this terrain and think more originally, and also for the holding companies of the telcos to taper expectations. I was a telco guy myself. I know how much big revenues we are looking for from the one. And the kind of governance questions they ask of the telco business, of their telco subsidiary, of their mobile money subsidiary, may focus them in what we call maybe the red oceans, which are going to be very hard for them to succeed. And these are the issues I'm learning, which we can continue to discuss through the day.
No, I always find it interesting because, because of the banking lobby's decisions, right? The good thing about a telco is that a telco is a telco, and you can box it into a telco and leave it there. But the new challenge with the fintechs is that now that they've built this distribution, now that they've built all these capabilities, nothing stops them from now saying, okay, now we want to become a bank and we can leverage this existing distribution. And now you've created a new competitor in your domain. Whereas with a telco, you could just now leave it because a telco is not going to threaten to become a bank. It's very clearly regulated. Do you think that, and specifically because one of the challenges, and we're going to come and speak about it later, is that a lot of banks are now really trying to grow up their POS business because a lot of the FMCG, volumes that are happening at the retailer level are flowing through all these fintechs as opposed to flowing through the banks.
Interesting one. I mean, I've been a telco guy myself. Telcos don't take prisoners. It is total annihilation. That's the way the telcos think.
Yeah.
So, I mean, legitimately in the mindset of the banking lobby, looking at the power of the telco, they were all out to ensure that they moved quickly, slowed the entry. But like I said, we actually have to look at the regulator. The regulator license setup created is different. The department, the payment services department within the regulatory department, out of bank supervision. And a whole lot of the fintechs that have been licensed over the last 5-7 years, very progressive regulation, are the ones that have solved this problem. But I think we would continue to knit the two. One of the hard questions I think my telco colleagues need to ask themselves, if you must go into the already contested market, what should be a differentiated play? Because it is not as if every financial services has been satisfied in the contested market. And if we must go into the 36% of the market that are left, given economic exclusion issues, which will create heavy lift in those markets, what should be our play? What kind of partnerships do we need to create? How do we work with government? Do we get to government, actually make our rail available for cash transfer that the government is struggling to do on a massive scale using our telco rail? These are the kind of questions the telcos should be putting forward. But they also want to be like OPay and MoneyPoint. And I think that's the challenge. So both from governance and downwards, there's a need for in markets like this for my telco colleagues to rethink the market strategy, the marketplace strategy, and the ecosystem partnership play that they need to have to succeed like in other markets.
Nigeria has been a pioneer in the payment space with NIBS. It set the standard, over a decade ago, and it's only now that other markets in the continent are starting to catch up. We're seeing this in South Africa with Paytech. We're seeing some efforts in Kenya with talks about a new payment system. One thing you've consistently mentioned is that there's the lack of integration between payments and identity. And identity systems are moving along as on a separate track to payment systems. We've seen in PIX in Brazil, there's kind of like an identity system embedded into their payment system. I think the India stack is a global example of what you can do when both those systems speak to each other. Like, where do you think African policymakers are getting it wrong when it comes to this kind of payments infrastructure innovation, and what are the costs of getting it wrong?
Thank you. That's a very, very good question, because we will work too hard to scale our potentials in digital ecosystem if we don't fix the issues in the digital public infrastructure layer, because everybody will try to be doing heavy lifting. Heavy lifting in silo, even on the private side. The lesson Nigeria first must commend NIPS for what they have done in terms of a national payment infrastructure. But the key lessons in Nigeria, I would describe it very interesting, is that when you have about 3 lessons, when you have 2 or 3 different agencies of government and the private sector driving different components of what should be an integrated digital public infrastructure, you tend to have this silo implementation in which one may be going faster than the other without coordination. And the clear example in Nigeria was that a digital identity system, the central bank, for example, waited perhaps for a digital identity system, according to the stories which we have gathered, when none was in place, working with a private consortium of banks put together Nigerian interbank settlement system as a national payment infrastructure, and created a bank verification number system, which is a digital identity system. Eventually, when another agency of government, which is the Ministry of Internal Affairs, got ready years after and started the digital identity system, we now have a situation where we have two national identity systems, the bank verification number and the Nigerian NIN, which are standing separate, and there are now attempts to bring them together, and of course there's a whole lot of friction and so on.
Yeah.
But what is more starking in terms of reality is that over the last 5 years in Nigeria, which I always pointed to, is a classic evidence for the world to learn. Digital identity in Nigeria have been growing at about the pace of 15 million new additions every year. To the extent now that we have virtually now about 95% or 93% adult coverage. But on the payment side, financial inclusion side, we are barely able to move the number of new additions to financial accounts by 2 million or 2.5 million, 3 million a year. So today, we now have about 120 million people of the national digital identity system.
Yeah.
But we have just about 70 million thereabout on the national payment on the national payment infrastructure. If we had implemented these two systems in coordination by a centrally coordinated agency of government, not even by the presidency, we will not have a situation where we have a 40 million gap between identity and payments. That should have been a low-hanging fruit opportunity. By now, if we have done the Indian model or the Brazilian PIX model, which were integrated system, UID, Universal Identity System, and Universal Payment Infrastructure together integrated. As soon as anyone gets identity, they automatically will be able to get information account. So we should have been able to have, if implemented a non-silo system by today, 150 million, 110 million financial accounts. Well, we're only 70 million. That's the biggest opportunity. That's one of the biggest miss in the financial inclusion program that anyone should talk about in the world, from the world to now, from the way in which we have implemented. And it's much harder to now find what I call those missing 40, 50 million people in the between identity and payments. And there's a whole lot of work to find them and bring them back into the payment infrastructure. The second lesson, very important lesson, is that given the fiscal constraints of African states, in which many of them are not able to fund the national digital public infrastructure, we had a unique situation in which a consortium of banks had to put in the money to start Nigerian interbank settlement system. One of the big questions comparing to India and Brazil is that it's the ownership structure of the interbank settlement system. Does it create a tension between public good and private enterprise in terms of profit? Because it's the banks that are governing NIBS. What kind of questions are the governing board of NIBS asking it? Is it a balance of public good? And are they asking sufficient public good questions? And when you also remove that to the compensation of managers in NIBS, if it's driven by revenue and bonuses, what exactly would they drive? Why they have to commend them, but the hard lifting, for example, of finding these 40 million people missing between identity and payment, would the incentive be strong enough to go and find those people? Because this actually correlates to the poorest of our people. People who do not identity or payments are also the poorest of our people. Is it worth the commercial wire? These are some of those questions that the world can learn. We see that as it's actually commending the pragmatic solution to the fiscal constraint of government. We must recognize the potential limitation compared to what we have in India and Brazil, where the government, the public sector, owned the digital public infrastructure as a public good and has used that to massively drive financial inclusion. NIBS have tried in terms of bringing down payment account to account interconnection fees at about 3 naira. But one of the things that we are yet to tackle because of the of that nature of private ownership of what should be a public infrastructure is that micropayments are still very expensive. Unlike what you have in markets like India and Brazil,
Precisely.
where micropayments are free,
Yeah.
and it has massively driven
Yeah.
financial inclusion. The real money is what we do on the payment infrastructure, and not how much we want to make in the private enterprise orientation on the payment infrastructure. And that's the contradiction between private ownership of what should be a national digital public infrastructure and public good and commercial interests. No matter how much our NIPS colleagues and the great work they have done, but the DNA of the organization is always going to will always be an issue. We commend them for implementing technology, one person in the world, but that DNA issue is something the world needs to learn for. Maybe it's the way to go because Africans still don't have resources.
Yeah, but I think it's you can say Africans still don't have resources, but like Africans are spending on defense, Africans are spending on building roads. I think, and it's something about prioritization of national resources. At the end of the day, as the world gets more digital, then giving your citizens basic payments and digital infrastructure now becomes a priority, right? Especially with so many young unemployed. And so I fully agree with you on the idea of a public good. I think that's the friction we are seeing across the continent. In Kenya, for instance, there's been a big tussle about whether the Safaricom and the banks play a key role in the new national payment system. And, I think Safaricom and the banks got together and said, actually, don't need one. The government should not focus on building one. Let us do it ourselves. It'll be a replication of efforts. And so you can see the same kind of energy that probably you're describing from NIBS. Without, and I think from what I understand with the central banks, they're saying, listen, this is a major issue, right? We can't have a situation where such a huge chunk of the GDP is going through a few platforms. That's even a sovereign risk. So it's beyond now just commercial. You're looking at things from a completely different perspective. So I think the idea of digital public infrastructure is super important. Now, speaking of the same, I think Nigeria, I always say Nigeria is really forward thinking in terms of like fintech and financial infrastructure. One of the things now we've seen, I think there was now the open banking regulations last year, right? And maybe there's an opportunity of even expanding access and expanding like the value of financial services. In your view on the ground, what are you thinking in terms of like open banking? Will it actually change anything, or are there any kind of structural issues that people are missing, or does it really move the needle in terms of like financial services in Nigeria?
Yeah, I mean, another very good question there. Open banking has the potential to create a revolution in our ecosystem. And I'll back up with that. Between 2010 and 2023, 30 years, digital payments grew 22% to 52%. Digital payment, according to data for open access to finance research. But access to credit in the same 13 years barely grew from 2% to 6%, 4% growth in 13 years.
Yeah.
So one stark reality is that we have a classic jaw-grab problem between payments and access to credit. And what in real life, what it means pragmatically, I mean, in terms of what you see in reality, is that incumbent financial institutions and payment players, but largely incumbent financial institutions, are sitting on chunks and millions of data and deposits of customers historically, and they will not lend to those ways. Our open banking system that compares, and that's the keyword I'm using, not that you want to do it freely, but by regulation compares third-party players to be able to have access to these 70 million people who has data are sitting in incumbent financial institutions and payment players.
Yeah.
And for those who want to lend to them using alternative credit scoring and those data with customer consent can potentially accelerate credit growth in Nigeria.
Yeah.
That is the biggest opportunity. But what you see is that we must commend our regulator again. Very progressive. They've done that with technical competition, and they are putting the policy. But what we need to move on is we need to encourage them to move into the actioning of the intended open banking policy, because the framework is there. The actioning are slowed down, and I suspect a couple of issues. The banking lobby is always very strong against things that can potentially level the playing field. But this is an example of the other issue where we have to balance what is the public good interest versus commercial interest.
Yeah.
Where social benefit extremely outweighs commercial interest, the regulator should move in the direction of what is good for society. And we can also carry everyone along. There can be a win-win partnership between those who will potentially lend, use the open banking platform, and of course, the equivalent financial institutions who are sitting on the terms of this customer information and data. But let me state that open banking will not solve everything. There are also complementary initiatives, regulation, and ecosystem that we need to put in place. And they are already getting in place in Nigeria. One is an expanded credit bureau system. As of today, fintech players and bank finance players who are outside the formal banking system are not compelled by regulation to put their data in the credit bureau until maybe in the last few months, when we started with new regulation from Federal Competition and Consumer Protection Commission regulating digital lending. That has the potential to create a wider credit record that will help us to price risk more appropriately, reward borrowers with lower interest rates, and encourage more people to borrow and pay back. That's something that will complement open banking. The third one is, again, commending Central Bank for Progress Regulation, is what we call the Global Standing Instruction System, where a lender can plug back from any account that the borrower has in the financial ecosystem whatever is due for payment, even when the deposits may not be sitting, the money may not be sitting in the lender's platform. What needs to happen with that platform from Central Bank is that we need to get more institutions outside banking into that platform, because what some of the clever borrowers do, they borrow from the banks, which are under the GSI, but you keep a lot of your money on the fintech wallet, which are not with the GSI system. So those kind of things, the GSI system, the expanded credit bureau system, by compelling everyone to put data in the credit bureau and open banking, would potentially accelerate the pace of credit growth, microcredit particularly in Nigeria, and the huge impact in terms of lifting a lot of our people from poverty to prosperity will be very huge. And let me add one more thing, in case we don't get there. In terms of access to credit, one of the big things we need to tackle in regulation in Nigeria is the regulation that prevents payment. One of the things we need to manage, or let me just tackle, the regulation that prevents payment players from doing credit. A lot of payment players cannot do credit by regulation, cannot credit services. And that's understandable, because the regulator is naturally concerned about financial system stability. But what we also see is that problem where after payment is growing, but the payment infrastructure as a payment rail is not being leveraged to provide next layer financial services like digital credit. And I think we should encourage the regulator to look at that. There's a way we can, it doesn't have to be either or. We can have financial stability and also have payments players be able to back credit by, for example, increasing capital requirements, for example, so that if a payment player wants to behave like a bank, then put in capital of a bank and make them comfortable in terms of financial stability, and also regulate them more intensively like the way you would do a bank. But let's not have a situation where payment is growing and it's completely isolated in terms of being leveraged for net layer digital financial services like credit, where the biggest future impact will be. So all this in combination with open banking will potentially revolutionize access to credit in Nigeria and the quality of life of the people.
No, that's for sure. I mean, I've always argued the same because if you look at one slice of the financial service industry, let's say supply chain finance, there's so much siloed information. Someone is taking an invoice, to be financed within a specific bank, and another bank just wants to check if that invoice has already been financed, and simple things like that. Like there are banks that are willing to finance small aspects of a borrower's business, let's say asset finance or supply chain finance. But the anchor bank, the main bank that business banks with, does not share statements, does not share anything, and is not willing to provide the services that other banks are willing to provide or other players are willing to provide, right? And so
Exactly.
if you could just get access to that information, we do it and the business grows, right? And you're right, like credit is a public good. I think what's happening is that people are looking at let's say the failures of open banking in Europe, and it's not necessarily a failure, but maybe it's just been not as revolutionary, and saying that since it hasn't been as revolutionary in Europe, it won't be in Africa. But it's a completely different context. There, the banks work. The banks are willing to lend any amount of money to someone. The information frameworks already exist. But here we
Exactly.
have to actually build them. Otherwise, things are gonna get stagnant.
Exactly. The credit bureau system, private credit formation is all over the place.
Yeah.
Africa needs open banking much more than the first world. It is here that we really need to have it because I've been on both sides. It's unlikely that banks will lend enough unless the competition comes into the market. That's why you also have, if people that lend, they are making abnormal profit. Uniformly profit because the market is very limited. Even we need far more competition in that place that will bring prices down and will expand access. And open banking, the key is very key in terms of making that happen.
Exactly. And you spoke of payments players earlier. One of the things that we're seeing in the market in Nigeria especially is that a lot of late stage fintechs are starting to make moves around consolidation and rationalizing their business. I think Paystack just recently announced that they're forming a holding company called the Stack Group, where they'll hold a microfinance bank, a payments company. I think Flutterwave acquired, Mono in Nigeria, and there's kind of like a maturity that's happening. I think part of that is largely because, as businesses mature, you have to think about diversifying your revenues, and then now you have to think about your long-term valuation, especially given that you have grown on the back of now this kind of valuation story. You've been on that side of like a really fast-scaling fintech player, right? What do you make of the consolidation that's happening? Do we expect to see more of it? And what's driving a lot of these kind of moves that we are seeing in the market?
That classic early maturity issues of an industry. The unintended consequence of fast-paced scaling of growth of fintechs is that you are also going to have early maturity problem. And that's what we are seeing in many sectors in which there's what I would call a classic competitive shakeout very early, in which the industries, the sectors or segments are being narrowed to 2 or 3 players. If you don't have scale, if you are not number 1 or number 2, you are not likely to even find any path to profit in the industry. The third guy is going to lose a lot of money, and the whole lot of guys who are 3, 4, 5 are burning capital. So that is what we will see. So I will say that we will see a lot of that early maturity tendency. It's going to be more intense over the next coming years, as you have mentioned, with Flutterwave and Paystack going for new businesses and diversify. That thing about when you have early maturity tendencies and there's pressure on even your traditional margins because of consolidation. The natural reaction is, where is the next growth? Where is the adjacent segment or sector in which I can find new inflections of growth for my business? So that's what we see. We will see a whole lot of that in the industry over the next coming years. But I think one of the important lessons that we are beginning to see, and our fintech colleagues must pay attention to, is what made us successful in our core business. And where the new inflections of growth we are looking for in adjacent segments. Um, are we going to uncontested markets that we unlock with technology, which is what we learn to do, where we are committed? Or if we must go into contested markets where there are early movers, one or two, are we going with a generic proposition or are we going with a differentiated play? We have seen one or two fintechs who try to do some adjacent play and they seem not to have succeeded because all that they seem to have done is to offer exactly what the early movers are doing. And lacking scale in those segments and lacking any differentiation, they seem to have destroyed capital. That's the question. That as we see this tendency, that's the question that I think our fintech colleagues will have to ask. If I'm going to play in the adjacent space, develop my revenue, do I have a differentiated play? Am I going to an uncontested market? Those are the two conditions for success. The other thing I think we are likely to see is we may see what I would call the erosion of pre-consolidation regulatory arbitrage in many of these places. One of the reasons, and we must be humble, I've been on both sides, back here and one of the reasons why fintechs, apart from our technology, we have done a lot of stuff, good work. But we must also recognize that we have been regulated in fintech compared to banks. And we have enjoyed at the early start a lot of regulatory arbitrage, working in between regulations and so on. Consolidation means bigger scale, being systemically important. It means that regulator will pay more attention. There are now 2 or 3 players rather than 5 or 15 fintechs in a segment. Regulatory scrutiny will be more intense. And therefore, previous regulatory arbitrage that might have been an advantage that some of us might have enjoyed might be eroded. Therefore, we may need to think about be more proactive in putting moats around our businesses in this new consolidation phase. I think those are some of the 2 things I think we have to be very conscious of. You cannot, on the long run, build competitive advantage of a business on weak compliance. Eventually, weak compliance cannot be a competitive advantage on the long term. Those are some of the lessons of this new consolidation phase I think that our fintech colleagues will have to be more conscious of in addressing.
And those are very valuable points. I think I've written, you've said it in a much more concise, elegant, and structured way than my thoughts were. But, at a very fundamental level, like, I think one of the new avenues for growth that is being targeted is lending. But, lending has a lot of nuance that is, completely different from payments. And one of the big things around lending is that most people don't understand that credit is very fungible, right? And therefore, if you whereas a businessman gets a loan, he doesn't care where he gets a loan. What it matters is that he gets it, right? And just because I am in the payments flow doesn't necessarily mean that you're my first choice for getting a loan and that you've got any priority in terms of like repayment, right? And so that usually now brings challenges for people getting from payments into lending, and then now finding a really carefully structured niche that can usually be a challenge. And then now, you're right. Like once you get to a specific level enough, not just, there's a regulatory side where now when you get to a specific size, the regulations change. But in Africa, even once you get to a specific size, the scrutiny on your business, both societal and political, even if you argue, becomes much more. It's one thing seeing this fun, cool fintech scaling. People think let them just do whatever they're doing. But once they get to a specific size, a whole host of problems start emerging. And I think those are some of the things they need to be careful as they scale their businesses.
Very good. I mean, you said it very well. I mean, we see, for example, even in Nigerian Senate, I mean, issues of fintechs were not the kind of thing you expect in the Senate of Nigeria being discussed. But Senator will raise, there's a new, attempts by some of the regulators to expand, I think the BOFIA, banking and other financial institutions regulation, in light of the size of fintechs today. And a senator stood up and said, I know the owners of these banks, but these fintechs, who are they? I don't know them. I don't know who owns them. these are some of the things, and that's the kind of, like you said, society and regulatory scrutiny based on the systemic importance at consolidation phase. This alone that this new maturity phase of fintech is going to increase, and we have to be more proactive. Yes.
Yeah. No, and it's a very valuable points. I think the next thing that I want to touch on, and it flows from this. So, on one hand, you're seeing a lot of these payment companies diversifying and getting into like new revenue streams, restructuring their businesses. But over the last, 5 years, 6 years, we've also seen the same activity from banks, right? So GT Bank, Access Bank, UBA, Sterling Bank, Zenith, they all have their own new fintech subsidiaries. And specifically, GT and Access Bank have gone really, even UBA have gone really heavy into payments and the POS business. I was speaking to a transaction banking lead at one of the largest Nigerian banks, and for him, is like, listen, if we're not careful, there's upstream effects of all this payments innovation happening on the fintechs, in the sense that a lot of the FMCG volumes are now being transacted with these fintech POS machines, right? And if that base is taken, we will just be seeing deposits, but we don't know where they're coming from, and we've got no way of adding value to that specific side of the business, right? Outside of that, like, why are banks rushing into fintech?
I mean, it's very clear. I mean, both in terms of the share of new growth over the last 5 years in the payment and on the merchant space, consumer payments on the merchant space. The traditional financial institutions have had very negligible share of that growth. And they've even lost some of their merchants and traditional consumers onto the fintech, because the fintech's wallets, the fintech systems are smarter, more agile, more better designed, and so on. And so what you see is that they are responding. The attempt to launch fintech subsidiary sitting in a bank, but where the cap of the bank is the right thing. And what they are doing is they recognize that they need to launch smaller, agile boats to compete in the fintech, in the payment and merchant, consumer payment and merchant space. That will be platforms that will be more agile, smarter than their frigate, elephant, mother bag. And it's the right thing to do. And what we also see is now that structure in which they are giving those fintech subsidiaries some amount of relative autonomy outside the banks to go and compete, which is the right thing, because I've been a bank, we'll try to do these things. The bank system will never make the fintech platform, so it's the right thing to do. But the real big question at one or two things. Would the holding company or banks truly allow those fintech subsidiary true relative autonomy to be agile and compete like a fintech? The jury is out. The jury is still out. If anything, what we have seen in Europe with banks like Royal Bank of Scotland that started Goldman Sachs that started their consumer business and had to roll it back, is that banks may still govern those subsidiary fintechs with the mindset of a bank in terms of immediate revenue expectations, in terms of agility, funding, and autonomy. And that may constrain how much of the success of these subsidiaries that we may see. It will need a whole lot of strong visionary CEO at the banking level that can protect those businesses, those fintech subsidiaries, and allow them to grow. The other thing I must mention, in terms of mindset, is that when you look at the share of operating profit of these new fintech subsidiaries, even the ones that are fintech subsidiaries banks, to the total group operating profit, it's probably like less than 1 or 2%. Now, what you tend to have, having lived within banking myself, what you tend to have is, will they have the patience like a private VC would have done to appreciate that even a 1 billion naira profit is very strong and it will be celebrated of a fintech. But within the banking holding structure, that probably would be a profit that a big branch in Nigerian can make.
Exactly.
Would they allow the experiments those fintech subsidiaries are doing to mature and scale like if they were independent of them? Or would they use the high volume mindset, short-term success mindset thinking of the bank to govern those fintech subsidiaries and underfund them? I think that's where the jury will be out over the next few years. We will see. The other thing is that what we also learned from Europe is that the fintech subsidiary banks that have succeeded, that seem to have made it, that the banks seem not to have rolled back, were the business fintechs. The business fintechs. And that's partly because the customer value, the economics may be much better in terms of the business B2B fintech compared to B2C fintechs. So maybe the kind of things that we see, but that GT Bank was caught, which is doing like B2B or Access Bank to hydrogen, maybe that's the direction to go because commercial revenues in terms of customer value, compared to, for example, the consumer side may be stronger. But even then, their jury will still be out. That will they really be valued within the fintechs, especially one other thing I must add. When CEO changes in those subsidies, in those banking holdcos, the CEO who are the visionary and the new CEO comes, who is looking for how to increase share price. Would they look at this 2% of my operating profit? You guys are wasting time. I'm not going to allocate capital to you anymore. And these are some of the things that they have to be conscious of. The jury is out. I will see how the next year plays.
Yeah, you struck the nails firmly on the head. These transitions, even it could be a CEO, it could be a division leader, it could be, all these kind of things. Like they just lack the kind of long-term thinking and stability, right? That enables some of these things to actually take off. And the issue about also P&L, one of the hidden dynamics that happens, and I'm sure you've seen it yourself, is that the CEO praises these new fintech guys, like these are the guys who are going to grow the bank. This is the innovation we want. And in those kind of exco meetings, the retail guy and the corporate banking guy are looking at this guy and saying, "You're bringing less than 1%, and we're here singing your praises. We are the ones who are carrying the bank. Who's this guy?" And it just creates a very toxic environment, right? So sometimes those foundational structures, those kind of political even issues within the bank, really make it hard. But then you've raised another point of like now the contested markets, and I think this is one thing that I wanted to do a follow up. If you are a chairman of a bank, you see the value in building this kind of fintech subsidiary, long-term agility. The world is moving, digital payments are making a play. We need to have something like that. But you then have to think of which market you want to enter into. How would you structure that decision, right? You've mentioned squad with B2B. You've mentioned the dangers of B2C. Like what kind of like blue ocean kind of areas exist for banks in that space?
The basis of strategy first, looking at a strategy place, look at yourself. What are your unique capabilities that others can copy, that you can leverage to play? I know I do hear sometimes we may be a little arrogant on the fintech side to say, we will take over. In my view, I think the future will be a play of both. Some banks will not make it, and some fintechs will not make it. But smart banks with scale, with infrastructure, with a fair customer base that have also innovated in terms of their core banking infrastructure, making them more agile. And I would say pursuing a two-track. When I was my previous years in banking, I was executive director for driving executive sponsor for the digital transformation bank. it's very difficult for my colleagues in Baki to understand it. But again, just to have that, is a two-option track. Digitize from within, give then pursue independent play of a fintech subsidiary, and have the courage to let them be for many years to pursue an experimental journey. Insulate them from traditional bankers who have short-term mindset and who are looking for the annual bonuses. I would think that, oh, these fintechs are dragging down what should have been my bonus for year. And the fintechs subsidiary do not have the political connection because they are younger with the CEO of the board. So a good board that recognizes that over the years, you will have options of what you do from within yourself and what fintechs may be. If, depending on how you place, you may have valuation opportunities with those fintech subsidiaries. Or you can have potential which can bring the two of them back together, maybe in the years to come, where the two options may meet. I think that's the, so if, as chairman of a bank, the first thing will be get a board that understands this twin option play. Get a board that will not use the performance metric of traditional banking to assess what the fintechs are doing in their space. Get a CFO, particularly, who is strategic beyond the short term, who is thinking beyond quarterly reports of the quarter performance report and share price in this context too. But also on the fintech side, also tell that, guys, we have to be more conscious. Yes, we're experimenting, but now that we're in the consolidation phase, efficiency and running well is so important. Let's see that we can see a path to that strong profitability that we all might, because on the long run, public valuation of markets of in fintechs and private valuation of markets in fintech, I think they are going to match.
Yeah, of course.
They are going to match. So some of these valuations that we see, $1 billion, blah, blah, if you are not also delivering the commercial revenues and the profitable revenue, operational excellence that will back those valuations up, those valuations will come down and you will not be able to go to public market. So I think that's the aligning executive management and the board in this twin track option play and letting those fintechs be over the times. Even when CEO changes, the board is committed to those journey.
Exactly.
I think that's what, as chairman of a bank, but unfortunately not a lot of people in the board, especially of the big banks, understands this. So, and that may be the reason why some of them may not make it. In this day.
For sure, there's a lot of mindset that needs to shift, and I think there's also that generational thing. I think if you look at the different generations, you look at people even like the current Gen Zs, and they've grown up fully digital, right? So,
That's
for
right.
instance, even things like building capabilities around tax compliance for your business banking capabilities, right? Like for Gen Z, it's like that should be logical, right? I don't see why I'm doing all my transactions here, and then now I have to go and deal with manual auditors, manual bookkeepers, manual,
Right.
And so for the older generation, they're like, yeah, but this is how you do your taxes. This is how you do these things. And there's that disconnect between like digital experiences and how people perceive their lives that is kind of driving this dissonance between the products we're using from our financial services providers and our just day-to-day experiences in the digital world. And I think there needs to be some kind of board training. Speaking
That's
of
right.
like now this new digital world, there's a report I think that came from Kenya that showed that agent transactions had declined by like almost $3 billion, right? It was a huge number, and some people are saying that we've reached peak mobile money, that that there's no more like the amounts of cash in, cash out, and just funds transfer we can do is reached the limit, right? And now these guys need to go beyond just basic mobile money services into now more platform type services, right? I think at OPay you kind of like saw this firsthand in terms of like you can give basic capabilities, but you can also do more. But you also
That's right.
saw that, this kind of modern digital platforms give you more opportunities to serve your customers than the traditional
Correct.
mobile money interface, right?
Right.
What's your take on this, and where do you think mobile money will go going forward?
Very agree. One of the things, and I think we need to give more publicity, get more people in the fintech space in Africa aware of the information you've shared about Kenya, agent banking revenue transaction declining by that volume. It should be expected because agent banking is a middle point on the journey to digitalization of the ecosystem.
Yeah.
When P2P, persons to persons and person to business, even person to government grows and become more pervasive, the need for a cash conversion intermediary in either direction will become more limited. And those are the kind of things that should be expected. The other thing is that compared to traditional telco mobile money and a platform thinking, telcos are infrastructure players. A platform designed from foundation to be real estate that will carry wider ecosystem play, different kinds of payments. For example, in Nigeria, you have cards, very mature. You have account to account. Then you have the USSD. A platform that can carry that, a platform that can partner, that can carry services beyond payments to next layer digital fast services conveniently and easily through API system that can plug into wider ecosystem place. That the traditional telco mobile money infrastructure coming from a telco life cannot be as agile as those internet native platforms like Alipay. And that I think we will see more of that. It's not surprising, for example, that even in Kenya, we are seeing the telco mobile money guys trying to go into more platform play. That is ultimately the way to go. So yes, telco mobile money riding on telco infrastructure is a jump start in terms of digital inclusion. But for wider orchestrated play, also in terms of scaling, efficient play in many directions, including beyond financial services, lifestyle services, like we have seen in markets like Asia. Platform direction like the Alipay model is the way to go. Like the WeChat model is the way to go. Is the way to go. And we should encourage more of our telco mobile money players to think in that direction. One thing I found interesting is that even when our telco guys, very interesting about our DNA from our support, even when we try to do platform play, when you check the apps of some of our telco mobile money players, it tends to be configured in the same way we use USSD. So even the navigation is coming from a USSD mindset compared to an inherently digital native platform that will use biometrics, straight experience. It preconceives what you have done, very smart and intelligent, very agile, and the customer experience is great and is plug and play for ecosystem players to work with them.
Exactly.
So yes, very valid. There'll be potential limitations, and in markets like Nigeria, where we already have platform plays, mobile so-called mobile money. I always don't like to use that word. Like mobile money, they tend to frame a narrow view of what a market should be. You actually try to satisfy payment needs. Anyone who calls themselves mobile money player needs to rethink, given that platform play is now becoming very visible and dominant. And when you enter the market, how do you enter the market and what do you do? Given some of these lessons that we're seeing between the benefit of a wider platform play and orchestration.
Yeah, no, it's true, and I think that's the foundational reason why, like, even in Kenya, I understand that M-Pesa is now embarking on a massive replatforming. But I always say with these things that you can buy the technology, but whether you buy the mindset and the vision, those are sold separately. We've seen huge
That's right.
we've seen huge experiments in the market where a specific bank say that what core banking is the other bank using. That bank seems to be having success. We'll buy the same core banking system, but that's just that's just one piece of the puzzle. There's a huge puzzle out there that requires that makes part of the whole. Now,
That's right.
we are one of the things I really wanted to understand from you is like, what trends do you think people should pay attention to, not just in Nigeria, but across the continent in terms of like fintech, digitization of financial services, and similar things that maybe people are not paying as much attention to.
Uh, the a lot of them would touch on in this conversation. We need to be a little bit more humble in the fintech space. We've done a lot of very good things, but the reality of running a good business and building the internal capability to run a good business that will justify our investor expectation, both in terms of people and talent. I think it's something that we have to pay attention to. We need to move. We have to start moving to what I call institutionalizing capabilities, not making them rigid, but making them flexible, but building true organizations that are keeping talents, that have strong commercial orientation, not just on the operational side, understanding things like finance. How do I run an excellent, a good business, particularly that everybody in the business understanding those things, leading people very well, not just being a techie. These are some of the things I think will be very important over the next few years. Of course, the issues of compliance, regulatory arbitrage. What do you do next in terms of where some of these arbitrage opportunities are eroded time? Those are some of the things that you need to pay attention to. And you ultimately, other people who learn strategy, but who have been good learners in terms of understanding the fintech space. How do we get more people to understand how strategy works and not to run the business strictly by entrepreneurial native intelligence? Bringing those two together and a good board that can share experience while recognizing the agility and the new operational experience of the operators of the fintechs. And some of the things those are some of the things I think will matter in the coming years. But commending our fintech colleague, great work. The other thing that we must also do, let me just add that, is that we need to be more socially conscious. How does the valuations that we celebrate translate to social impact in terms of the life of people? Because at the point, somebody is going to question, okay, yes, you guys, your valuations, blah, 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 but okay, so what have we done for the people who have not been covered historically? What are we going to do about that? So those are some of the things. They are all part of different things within the pot. Thank you.
No, you're right. I think I was having this conversation that there needs to be this kind of like real culture of world-class operators in the fintech space. A lot of people are just experienced at working in fintechs, but they're not necessarily world-class operators. And I always say, like, for you to make it at an executive director at a bank, you have to have worked, you have to be like the top 1% in your industry, right? And that's what makes banks sustainable. That makes some of these incumbent organizations sustainable. So that, maybe it's something at Lagos Business School you can do to now build the next generation of fintech leaders.
Yes, we are trying, but some of our fintechs, the ecosystem needs to be more committed to learning. We tried to do a program last year. We started programs managing a tech startup business. And one of our key learnings on that program is that our fintechs and our tech people are not willing to pay. We tend to be more interested where somebody from overseas is going to have some capital to say, if you come on this program, you can get maybe some seed funds or something. And it's a very important line. We are rethinking those kind of programs. We need to find partnership with venture capital and stuff. But what it tells us is that the traditional commitment to learning, recognizing capability that is to be built, that you have in one mature organizations. Some of our fintechs, many of our fintechs are not paying attention. It's next step. Just go to the next. I think it's something we need to pay. The commitment to institutionalized structured learning in the fintech and technical system, beyond just webinars and conferences where we go to talk. And you can go into, there is no, as someone said, as I always say, there's no good practice without good theory. Theory is the experience of practitioners that are codified into some knowledge. And we need to bring the two together, more attention to learning about fundamentals. And even when we have to tweak it in the context of fintechs and the dynamical systems, okay, if it works in context A, but the foundation learning will enable us to ask the right contextual question in the context of our fintech business. But when the foundation learning is not there, we will just be experimenting, getting right and miss in terms of getting right with knowledge, and which may affect the kind of operational excellence that is needed in this consolidation phase.
100%.
And we may end up hiring a whole lot of people out of Africa, working remotely, rather than hiring our people and building capability within the continent. Which is some of the things which I see with some of our fintechs, hiring those experiences from overseas. Let's also build it at home in Africa here, and our business schools can play a very solid role supporting the fintech ecosystem that we are trying to do.
Exactly. No, thank you so much, Olu. This has been exceptional. Like, really appreciated your sharp insights. I always knew that this was going to be a great conversation. So thanks for joining us on the show.
Thank you. I once again, Samora, thank you on behalf of many of us that read your weekly writings, the deep insights. Thank you for what you do, and best wishes. And thanks for the invitation again.
Thank you.
Your essay on Nigeria is creating a lot of stirring up conversations of where they have been shared. But very interesting, very good, fresh perspective from outside.
Yeah, I'm glad. Sometimes you need an outsider to tell you your problems better. I always say that's why couples go for therapy, so that they can get an outsider perspective. Thanks. Cheers.